and friends. I have a pleasant task to introduce Sri Bipin Pawar, a partner with PwC. He has over 15 years experience on diverse matters such as investment and transaction structuring, optimizing benefits under income tax laws and treaties, addressing regulatory issues and tax compliances. Since introduction of the transfer pricing regulations, Mr. Pawar has been advising clients on innovative TP opportunities and strategies, combining industry insight with technical skills to provide holistic solutions from commercial, tax and regulatory perspective. His experience includes strategizing and implementing supply chain structures to optimize global effective tax rates, IP migration, developing local and global compliance, documentation, evaluating P issues, developing defense strategies for transfer pricing audits, integrating indirect tax positions and harmonizing transfer pricing and custom documentation. His clients includes companies in the sectors such as pharma, medical, chemicals, electronics, FMCG, logistics and telecom industries. He is a Bachelor of Commerce and also a member of ICAI, and he is regularly contributing to ICAI chambers and Bombay Chartered Accountants Society. So we have a very learned speaker here, and he is going to talk to us on the recent developments in transfer pricing, especially on BEPS, business base erosion and profit shifting. So that is something which is gaining a lot of relevance in today's scenario. So with this, I present before you Mr. Pawar. Now, before we request you to make a presentation, may I request Yatin Bhai, our president, to present a memento.
Good afternoon, friends. The subject of my presentation is actually threefold. I'm going to cover some recent developments. I'll try to cover BEPS, but BEPS as a topic is a very large topic. So there are 15 work streams. And to be able to cover BEPS in a 1-hour session and to cover all the 15 work streams is not going to be feasible. So I'll try to give you a flavor of what BEPS is all about, what are the themes over there. And then within that, I will spend more time on the transfer pricing work streams within BEPS. So there are 3 work streams within BEPS which focus on transfer pricing. So we will cover those. And then the last part of my presentation is going to deal with the interplay between GAR and transfer pricing. Objective here is not to give a theory on GAR, because I'm sure much has been said and written about GAR, but we'll focus on how does it really interplay with transfer pricing, and that's going to be the theme of that discussion. When I was thinking about what I should present on recent developments, a lot of thoughts came to my mind that the subject has evolved so much. And there are so many developments to cover, so I really had a hard time to figure out, what I should talk about. And so I thought that the best way to do it is to put it on a timeline, and then cover at least the key developments which are relevant to India. Actually, there are far more developments here, but I've not tried to cover all of them, but trying to cover the key ones from an India perspective. September 2012, going back in time, the India's APA program was issued, and everybody in India, all the consultants and most taxpayers in India were looking at this very closely. The government also was important to put up, for them also it was important to launch this program, because they wanted to give an impression to the outside world that we as a nation are not a banana republic, and there is sanctity at the end of things. So somewhere there was an effort on the part of the government to launch this program to sort of mitigate the adverse reactions that were coming from the industry against what was happening on Vodafone and stuff like that. Transfer pricing adjustments at that time were again, very huge adjustments were happening. So again, there was an effort to launch this program to quell the hot reactions that were coming on the transfer pricing side. So financial year 13-14 was the first year of this program, and taxpayers who wanted to opt for an APA, they were required to file in their applications latest by March 31, 2013. In the first year of the program, 146 applications have been received, and 5 APAs have just been signed, and that's, they took about a year to sign 5 APAs. Our program is very much along international best practices. So for those of you who have not looked at the APA program, we have a dual stage. There is a pre-filing stage which is mandatory. The idea of the pre-filing request is that the tax authorities will give you a broad direction. It's not a binding and a conclusive meeting, so they will not tell you whether they will give you the APA or they will not give you the APA, but they will guide you that in the facts of your transaction, is that a good case for an APA? And sometimes that direction is enough for a taxpayer to take a decision. The pre-filing request can be anonymous. There is no obligation on you to disclose the name of your company, and they don't even charge any filing fees for a free filing discussion. And then followed by pre-filing, the main application is required to be submitted. Main application has significant data requirements, and you should actually budget no less than 2 months to 3 months to prepare that main application, because it actually takes that much time to prepare it. So that's about the APA program. The response of the APA authorities has been very, very constructive. So I'm told that in the second year's cycle, the number of APA applications that they received has actually crossed 250, which essentially means that in 2 years' time we are looking at 400 applications. And I doubt anywhere in the world, even in advanced nations like the US or the UK, you will not find these kind of numbers. So that's an indication of the fact that the program is actually going very well. In January 2013, we had the special bench ruling in the case of LG Electronics on marketing intangibles. What that ruling essentially said in the facts of LG, and LG's facts were that they were a licensed manufacturer for the Indian market. They were paying royalty to the Korean parent. They were importing raw materials and components, and then they were manufacturing home appliances. The critical point to note was that both the royalty payment and the raw materials that they were buying, LG had independently tested them to be arm's length, and therefore after making those arm's length payments for royalty and for import of components, the residual profit that remained entirely remained in India. The special bench took a view here that LG was spending on advertising and marketing for the domestic market, and they took a view that LG's advertising and marketing spend was significantly larger than spends of the comparable companies, measured in terms of advertising to sales ratio. And they said that this difference constitutes excess AMP spend. That AMP spend confers a benefit to the parent company because it strengthens the brand of the foreign company, and therefore it's a service which needs to be compensated. So that was the crux of the LG issue. With due respect to the special bench, the principle that they've held is completely incorrect, as any transfer pricing professional will tell you, because if the question here is that before you even decide that is there really a benefit that is being conferred to the foreign party because of AMP spend, the question that has to be asked is that when an Indian company spends on advertising, who is it really spending on advertising for, and in what form and manner has a benefit been conferred to the foreign party? So here the facts of the case were that the foreign company did not have any direct sales into India. Okay, the facts of the case were that LG was paying royalty, and that royalty was independently tested to be arm's length. LG was also paying for raw materials and components, which was also independently tested for arm's length, and therefore after having made those payments, whatever remained, the Indian company was retaining in its books of accounts. So it took the risk of investing in the domestic market, and it kept the full reward. In what form and manner is the foreign company really benefited? So here the convoluted thing that they came up with was that to judge whether a benefit exists, they looked at the comparables, and they found that LG was spending too much money, and they said that this excess money which was being spent on advertising and marketing constituted a benefit. Now, in reality, that's not how it ever happens. If you analyze license agreements anywhere in the world, you will find that licensees everywhere in the world are expected to spend on advertising and marketing to develop the market, and that's how they make money. You will never find a situation where the licensor says to the licensee that you spend the money and I'll compensate you even more. It never happens anywhere like that. So be as it may, this ruling now exists, and TPOs around the country are applying this ruling on a day-to-day basis. And there are a few cases that have now reached the High Court stage. I think in the case of Canon India, Casio, I think the Delhi High Court has admitted questions of law on this. So we will have to wait and see what the outcome of this is. I'm quite hopeful that this ruling somewhere in the future will probably get reversed. February 13, OECD issued its initial report on BEPS. We are going to touch upon what that report contains, so I'm not going to go into it in too much of detail. March 13, again, TP audits got concluded, significant adjustments were made, and in the 12-13 audit cycle, the theme was issue of shares, marketing intangibles, location savings. I think most of you already know what these three topics are, so I'll just take a minute each on each of these topics. Issue of shares is a transaction where an Indian company issues shares to a foreign company. The tax and in this year, the valuation methodology which was mandated by the RBI was CCI guidelines, and CCI guidelines were then replaced by discounted cash flow from April 1, 2010. So for financial year 9-10, CCI guidelines were in place, and as per RBI, that was the floor value. So that was the minimum that an Indian company was expected to bring into the country when they issued shares. An arm's length price could obviously be higher than the floor. So here, most of the companies that had issued shares, they had obviously used CCI guidelines. So the tax authorities said that CCI guidelines does not result in an arm's length valuation, because it really is it's an arithmetic mean of net asset value plus profit earning capacity value. So it cannot be taken to be arm's length. So they said the right method to value the shares is using discounted cash flow, and the difference is something that they brought to tax. Here the big issue was that when you issue shares, there is really no income that arises from an international transaction, and how can therefore transfer pricing provisions apply to such a transaction in the first place? So that was the big issue there. The second big issue around this was that having brought the alleged undervaluation to tax as income, the tax authorities then said that since the Indian company has attempted to pass on a benefit to the foreign company, that's in the nature of a deemed loan, so they imputed interest on top of the deemed loan. So the issue around that is that under Indian transfer pricing law, the way it reads, and here I'm not talking about GAR, we'll look at how GAR changes things, but under Indian transfer pricing law, there is really no mechanism to recharacterize equity into debt. So recharacterizing equity into debt constitutes a secondary adjustment, and under Indian income tax law, those provisions currently do not exist, and therefore the department actually did not have the mandate to do something like that. This issue again traveled to the Bombay High Court in a writ petition by Vodafone and Shell. The Bombay High Court directed the DRP to first deal with the jurisdiction issue, and then the taxpayer has the discretion to come back to the High Court in a writ petition if it chooses so. We have to wait and see how this issue evolves. Marketing intangibles, we talked about the issue of LG, so I'll skip the issue of marketing intangibles. Basically, the department applied LG's rationale into every single case without actually distinguishing between the facts of a licensed manufacturer, which was the case of LG, and the facts of other taxpayers like distributors, for example, where the issue of marketing intangibles is actually relevant. So we'll cover that in the subsequent slide. Location savings was another big adjustment that happened in most cases, and that happened in cases where there was outsourcing to India of services or of manufacturing. So the issue really was that in cases where foreign companies had outsourced provision of services or provision of or undertaking of manufacturing to India to obviously take benefit of the cost arbitrage, the tax authorities argued that because the cost base in India is low, there is a competitive advantage which is conferred to the foreign company. They save costs, and part of that cost savings under arm's length should belong to India. Now that principle in itself is not wrong, but how the tax authorities went about applying it was completely berserk. The principle here is that even before you look at who should rightfully get to keep the location savings, because yes, every time there is some outsourcing which is done to India, there is a cost saving that is achieved. But the question is that this cost saving may not always result in incremental profit for the foreign company. So even before you start talking about whether this cost saving needs to be shared with India, one has to first figure out that is there really incremental profit that the foreign company has earned? Is there a competitive advantage that has actually been conferred to the foreign company, that which is not available to everybody else? And only if these two tests are crossed, then the question of sharing arises. So to take an example, let's take a look at the pharma industry. The Indian pharma industry is growing to a large extent because of Indian companies offering contract manufacturing services. If you just do a search on Google, you will come up with a list of at least 500 contract manufacturing companies in India. Now, in a situation where there is perfect competition in the Indian market and there are so many players who are offering similar services, even if there is a cost saving that arises, under arm's length, an Indian company cannot afford to overcharge its customer. And therefore, there would be no possibility of the foreign company ever sharing that cost saving with the Indian company because the market is perfectly competitive. So these are subtle differences, distinctions that the tax authorities did not really apply. They said that they wanted to know what was the cost saving that the foreign company had enjoyed, and in cases where the taxpayers were not able to share that information, they did something arbitrary. In some cases, they've even attributed 80% of the cost saving to India. And the question really here was that if 80% of the cost saving is attributed to India, then you will see that a contract manufacturer ends up showing much higher profit than the entrepreneur who's sending that work to be done in India in the first place, which is an absurd situation. March 13 also saw 146 API applications being filed. We talked about it earlier. June 2013, the reporting requirements in Form 3CB were expanded, particularly as a reaction to the expanded definition of international transactions, wherein items like corporate guarantees, issue of shares, etc. All of those things were defined and put into the definition of international transactions itself. So the form was expanded to require taxpayers to report these kind of transactions. The issue here fundamentally remains the same, that while on one hand the form now requires you to report these transactions, the question still remains that is the form really ultra vires the act itself, because the definition of international transactions cannot create a service when none exists. So for example, in the case of issue of shares, just because the definition of international transactions says that that purchase or sale of marketable securities is a transaction, that does not mean that income arises from that transaction, and therefore that definition cannot override 92(1) itself. 92(1) is the arm's length standard, and 92(1) clearly requires, before TP provisions are applicable, the tax authorities need to show that there is actually income arising from that transaction. So the question of whether this form is ultra vires the act will still remain, but be as it may, taxpayers are now mandatorily required to report this, so that these transactions can be reviewed by the tax authorities in the assessment proceedings. In June 2013, the UNTP manual was also issued, and the UNTP manual had chapter 10 in it, which basically contained chapters on specific countries. So there were 4 countries that were covered as part of that: India, Brazil, China, and South Africa. The UNTP manual clearly said that whatever is contained in those chapters does not reflect the consensus view of the UN subcommittee. Those are views expressed by the respective tax authorities in terms of how they want to administer transfer pricing in their country, but that does not necessarily reflect the view of the UN subcommittee. In this UNTP manual, India has expressed its opinion on various issues. Many of the things that they've said over there represent India's view on those transactions, but not necessarily the OECD view. So, for example, in the case of location savings, India has expressed a view that just because the Indian company who is, let's say, operating as a outsourcing company, whether a contract manufacturer or a contract service provider, just because that company is achieving the right amount of margin compared to the comparables, that does not mean that location savings, if at all, is already embedded in the margin of the comparables. Now that again is not the right principle, because if you have chosen your comparables properly, if let's assume that you are an exporter of services and your comparables also constitute significant exporters of services, then any location specific advantages or premium that that service provider is deriving will be naturally reflected in the margins of the comparable companies. And therefore, if you've benchmarked such a transaction properly, then it's obvious that nothing further can be paid to India, because whatever further was due is already given. But India has gone ahead and said that that's not the view of the Indian government. Over and above the margin of the comparables, India wants a share in the location savings. There are other, so this was one area where they expressed a very, very strong view. The other area where they expressed a very strong view was in the context of outbound loans, where Indian multinationals who are investing in foreign countries, and for funding those investments, sometimes they take huge loans or which are counter guaranteed by the Indian company, or sometimes the parent company itself grants a loan to a foreign subsidiary. There, India expressed a view that the arm's length rate of interest that India should expect to earn from the overseas subsidiary cannot be linked to LIBOR or MIBOR, LIBOR or Euribor, but it has to be linked to a local reference rate like the prime lending rate. Now this again is a very ridiculous proposition, because if you are lending in the overseas market, you cannot be expected to charge a borrowing rate which is prevalent in India, because the cost of borrowing in India is too high. Just take an example. If an Indian company were to ever lend into the Japanese market, for example, where the prime lending rate is just 1%, will a Japanese company ever agree to pay to India 14%, which is the prime lending rate in India? It just won't happen in real life. But that's the view that they have expressed, which in some form is now also manifested in the safe harbor notification that they've issued, where they've said that when an Indian company gives an outbound loan or there is a guarantee given in favor of a foreign company, the rate has to be linked to a local borrowing rate like the prime lending rate or the SBI PLR. July 2013, OECD issued its action plan on BEPS. So 15 work streams were covered. We'll talk about this a little later, so I'm not getting into it right now. July 2013 also saw the appointment of the new competent authority. So Mr. S.K. Mishra, left his office, and we had a brand new competent authority in the form of Mr. Akhilesh Ranjan. Now that's seen to be a very, very positive thing to happen, and people are hopeful that some of the very tough stands that the previous competent authority took, especially on use of profit splits. The previous competent authority had said that in most cases India would like to apply profit splits, and generally TNMM would not be the right method. So there were very strong observations that had been made earlier. We hope that with the new competent authority coming in, some of these stronger stands which have created a lot of controversy internationally will perhaps look to get revised. There was revised guidance also issued on transfer pricing treatment of R&D centers. And there the big controversy was that when you have a contract R&D service provider in India, what should be the remuneration model for rewarding the contract R&D service provider? The view of the government in some cases was that they felt that significant value was being added here, intellectual property was being developed because of contract R&D, and in some cases the TPOs, they said that the contract R&D service provider should not get a cost plus remuneration, but they should get a share of profit in the product which was commercialized as an outcome of that research. So that was the stand being taken in certain cases. And in this notification, the CBDT laid down the correct principles. Those principles were always available internationally. The principle was that whenever you are doing contract R&D, the significant people function is the function of who exercises control. So just because the contract R&D being done in India is very complex or high value added, and it may even involve employment of scientists, That does not automatically mean that the Indian company should get a share in the profit. The critical question here is that who performs significant people functions, and in the context of R&D, those significant people functions are that which is the product to be developed, which is the product to be researched into. That function is typically with the foreign company, because they would base that decision on survey of the market, the end target market, because no R&D will start unless somebody has first decided that is this product that we want to develop really has a market. So that function is a crucial function which the foreign company would usually undertake. Once that decision is taken, then the foreign company would then also decide what the R&D budget should be. They would monitor the progress of R&D, and in certain cases where the R&D is not going along the right direction, they can even take the decision to abort the R&D. So these are the control functions, and if these control functions are residing outside of India, then the remuneration model for remunerating an Indian contract R&D service provider should be cost plus. So that's a principle which is internationally accepted, was also endorsed by the CBDT, which was a very welcome sign. In July 2013, OECD issued its action plan on BEPS. We'll cover BEPS again, so I'm not dealing with that here. Just around July 2013 also, the second discussion draft on TP aspects of intangibles was also issued by the OECD. Now that's a parallel project of the OECD, though it has a significant overlap with BEPS, because intangibles is also one of the action points in BEPS. At some stage, OECD says that because the intangibles draft is work in progress, they will converge what they are saying in the intangibles draft with what they will eventually say in under BEPS. So that's something that is waiting to happen. August 2013, the Tax Administration Reform Commission was constituted under the leadership of Dr. Parthasarathi Shom. This commission has been given the mandate of studying how India's tax policy has evolved and to make recommendations to the government periodically on whether our tax policy needs to be changed. The objective is to increase the capacity of the Indian tax system. This committee is expected to have, in fact, they've already announced the committee. It's expected to have 2 full-time members and 4 part-time members, out of which at least 2 part-time members will be from the private sector. So that's again a good sign. August 2013 also saw a landmark ruling in the case of BMW. Now this was a ruling of the Delhi tribunal where for the first time since LG, the tribunal actually took a view which was different from LG. So the facts of BMW's case was that BMW was a distributor. They would import passenger cars either in fully developed form or in kit form. And what would happen in India was very limited value addition. So an assembly function was happening here. The car in, the substantial economic value addition was already done outside India, because, just because you're importing the car in a kit form and developing it here doesn't mean that value gets added here. The function that was happening in India was economically a very simple function of assembly. And therefore, for transfer pricing purposes, BMW was positioned as a distributor of cars who adds a little bit of value. So the transfer pricing mechanism was devised in such a way that on the import component, BMW India would get a distribution margin, and on the local value add, which is the assembly function, they would get an additional return on top of the distribution margin, which is how the transaction actually needs to be seen. The department to begin with applied LG Electronics without distinguishing between the facts of LG and the facts of BMW. And in this case, before the tribunal, BMW actually pointed out that when the LG ruling was delivered by the special bench, BMW had actually joined as an intervener, but had later on withdrawn as an intervener because the tribunal was not prepared to deal with the facts of a distributor. Now, if that is what the facts were, then how can LG be automatically applied to BMW without understanding, how does the position on marketing intangibles actually change for a distributor? Now, what this principle actually brought out was that a distributor of goods, for all practical purposes, is akin to a service provider. He is not selling his own goods in the market. He's importing goods which belong to somebody else, and then he's undertaking marketing and sales and then selling those goods in the Indian market. And that marketing and sales function is essentially a service function. So if you look at the profile of a distributor, there are two things that the distributor needs to get rewarded for. There is a service element in it, which is the marketing and sales, and there are certain risks that a distributor takes, which are consequent to ownership of inventory. So for example, credit risk, because the title passes through the distributor, so the distributor takes credit risk. The distributor also takes inventory risk because he keeps title to the inventory. So the point that was argued in BMW's case was that if a distributor is essentially like a service provider, and because a distributor is like a service provider, the foreign company has the ability to restrict the return of the distributor. So the foreign company would usually say that, look, I'm giving you a gross profit margin of say 20%. And so the end selling price is, let's say 100, the margin of the distributor is 20, and therefore the import price would be 80. Now this 20 has to be adequate to cover the costs of the distributor and to leave the distributor a certain profit. And so what BMW argued was that as long as they can show that this gross profit margin is the right margin which adequately covers all the costs of the distributor, including advertising and marketing, and leaves the right profit, then advertising and marketing expenditure has already been funded by the parent. Okay, as long as you can show that the GP margin is the right margin. And therefore, once that is proved, then nothing further can be paid to the distributor. So the principle that they said was that it is not necessary for a distributor to be funded for AMP through a separate reimbursement. If you can show that that funding is also coming in the form of keeping your import price low, which allows the distributor to cover his cost and to earn the right reward, even that is sufficient. So this was a case where the tribunal took a view which was different from that of LG. It's a very landmark ruling. Unfortunately, there have been other rulings after BMW also where tribunals have blindly followed LG, even in the case of distributors. Casio was one such case where Casio went to the Delhi High Court, and substantial questions of law have been admitted in the case of Casio. September 2013, GAR provisions, the notification was issued in terms of, to sort of dilute the rigors of GAR and to notify some administrative procedures around how GAR will be implemented. So that's, we're going to talk about GAR in terms of how it interplays with transfer pricing. We're not going to get into, the theory around GAR. September 2013, we saw more than 50 APA site visits getting completed. And as you will see in March 2014, they finally signed 5 APAs. 5 out of 145 is still a very slow start. But I would believe that, most of these 145 applications that were filed in the first year would have been for cost plus cases. And within that, most of the cases would be IT, ITS. Many of those cases will be investment advisory. Many of those cases will be contract research or contract R&D. So once you have some representative cases being negotiated, then tax authorities will probably apply that logic and those kind of principles to other cases as well. So the first 5 cases have been very difficult, but I would believe that in the next 6 months, you will see at least 50 or 60 AP applications getting signed, primarily because of the progress that they've made on the earlier cases. Safe harbor rules were also notified in September 2013. They have now notified safe harbor percentages for provision of IT services, ITES, software development, back office services, knowledge process outsourcing services, contract R&D, provision of guarantees in an outbound scenario, and provision of a loan in an outbound scenario. So these safe harbor percentages have been prescribed. These safe harbor percentages are still very high as compared to what the arm's length standards are. And therefore, my sense is that, you will not see too many taxpayers really going under the safe harbor. I think large taxpayers who have, too much money at stake will still follow the arm's length standard, will still do benchmarking to set their margins. Because if you directly follow the safe harbor, there will be a risk that you will be non-compliant on the other side, because no government outside of India is going to accept 22% margin for ITS services. It's just too high. It's almost like giving a stock exchange return to a captive service provider, which would usually not happen in real life. So chances are that the safe harbor notification will have limited applicability, and it will mostly be used by small taxpayers, where they really have to strike a balance between maintaining documentation and avoiding litigation at the same time. So if you are a taxpayer which has lesser volume of transactions, transaction value small, go under the safe harbor, don't worry too much about it. But if you are a taxpayer with 500 crores of exports or whatever, I don't think a safe harbor would make too much sense. So that's a quick summary of how the last 2 years have been for the Indian transfer pricing environment. Now, what is this BEPS really all about? Okay, BEPS stands for base erosion and profit shifting. Now, what's been happening really is that there are different ways in which around the world the tax base of countries can get eroded, and profit shifting is just one of the many ways. And governments around the world have been concerned with this for a long time. I can tell you that as back as 1988, OECD first started its work on looking at harmful tax competition and stuff like that. And some of those principles have now come into what the OECD is doing on BEPS. So it all started somewhere in the late 2012 or February 2013, where the G20 nations requested the OECD that since OECD was already doing a fair amount of work in this area, the G20 nations requested the OECD to submit a report of what's the status of that work. And the G20 countries wanted to discuss, the finance ministers who were part of that forum wanted to discuss the status of that work in their February 2013 meeting. And therefore, in February 2013, you saw the OECD issuing their first report on BEPS. And what that report really talks about is the different forms and manner in which profit is getting shifted from countries to countries. So they looked at tax structures around the world. They gave some examples, and they also identified some 12 to 15 pressure areas, which they said that those pressure areas had to be looked closely. For example, digital economy was a pressure area, and they thought that that's one area that they needed to look at very closely. Misuse or abuse of tax treaties was another pressure area. Harmful tax competition, where you have a jurisdiction which is giving incentives, and and that attracts investment there, and sometimes those jurisdictions are misused. There is no substance there, but you set up a company, you route your transactions to those countries. So that was again one more pressure area. So there were some 12 to 15 pressure areas that they identified, and then they said that OECD will look at each of these pressure areas and come up with action points. So they gave themselves 6 months to come up with a set of action points. So that's how really the whole thing on BEPS started. But what was the trigger for this BEPS? The big trigger for this BEPS around the world was that the global economy is going through significant recession. Most countries have significant fiscal deficits, and therefore you will see that revenue aggression is not only increasing in India, but it's increasing everywhere in the world. If you are just tracking some of the big ticket controversies that are happening in the UK, for example, where the inland revenue went after Starbucks, they went after Amazon.com. They said that Amazon.com, which was conducting its business through Ireland, the inland revenue said that Amazon was paying very little taxes in the United Kingdom for sales, internet sales which are made into that country. Amazon's reaction to that was that they were not doing anything wrong, because they said that most of these sales were affected from Ireland. The server was located there, and all that was happening in UK was just marketing and sales, and whatever was the margin that was attributable to marketing and sales, they were offering it to tax in that country. So Amazon said that in terms of the tax laws that prevailed, both under the treaty and the domestic laws, they were not doing anything wrong. They were within the spirit of the law. And the allegation that was made by the inland revenue was that you are not paying your fair share of taxes. Okay, same thing happened with Starbucks, and there was a lot of media backlash. And Starbucks actually was concerned that this media backlash will result into a negative consumer perception. So Starbucks actually went one step ahead, and then they voluntarily agreed to pay 20 million as taxes, even when they were not supposed to or required by law to pay it. So those kind of things are happening. Governments around the world, as a reaction to the slowdown, are announcing austerity measures. So there is spending, cut in public spending. So those are big ticket triggers that are happening, and that is really fueling this whole thing on BEPS. So when we look at BEPS, if you look at the larger theme which is there in BEPS, what are they trying to address? They are trying to address situations where, forget double taxation, but there are many cases where, there is less than single taxation or double non-taxation. So where a particular transaction completely escapes taxation in both the countries. They are looking at situations such as that. They're also looking at how are multinationals reporting their profits, and are profits being reported in countries where there is no or low economic activity. And that's also an indication that you have attempted to shift profits from countries to countries. So those are the large overriding themes of BEPS. The OECD report acknowledges that the key reason why the BEPS has taken center stage is because our tax laws have not really kept pace with how the global economy has evolved. So most of our tax treaties still continue to be based on principles which were generated in the early 1920s, mostly out of the work that was done by the League of Nations. But are those treaties really geared to handle today's situations? For example, let's take the example of, say, digital economy. How do you, for example, look at the place of disposal test, which is in Article 5.1 of the treaty, in the context of a e-commerce transaction? Where is the place of management involved? Those kind of answers. So what was happening was that there was a thinking that our tax laws need to evolve. They have lagged behind, and as a result of that, and also because businesses have also evolved. Today, you can virtually do a board meeting through teleconference or through video conference. You don't need to be physically located in a particular country. So in such a situation, how do you say that my place of effective management is in country A or in country B? Which country should get the right to tax the profit that arises on account of significant people decisions? So organizations have evolved. Businesses are now global. Decision making is also in the form of a matrix structure where an employee's reporting line may go to the CEO of that country, but he has dotted line relationships with people outside their countries also. So as a result of that, there are opportunities that sometimes get created for double non-taxation, for example, where you exploit loopholes that are there in treaties, and then that income is actually not brought to tax in any country. There are sometimes gaps and mismatches between tax systems as well, and sometimes it also results in intentional or unintentional abuse of tax systems. Like they say that the effort of one government to promote investment sometimes can be viewed as tax avoidance by the other government. So where does a taxpayer go in all this? You're actually caught between two sides. So that's really the theme of the OECD work on BEPS. What they have done is they have identified 15 work streams. These are the work streams addressing challenges of digital economy, which will look at how e-commerce transactions should be taxed. Where is the situs of the transaction? Is it where the buyer is? Is it where the seller is? Is it where the goods are delivered? Is it where the server is? Who gets the right to tax? What points of time tax should be collected, especially for indirect taxes like VAT, for example. So those kind of issues they will look at. Neutralizing the effect of hybrid mismatch arrangements, CFC rules, limit base erosion via interest reductions and other financial payments. So 15 different work streams. OECD gave themselves a deadline, which in most cases is about 1 year. And in some cases, they have also issued discussion drafts. So digital economy, a discussion draft has come out very recently on March 24 itself. Hybrid mismatch arrangements, again, 2 discussion drafts have been floated by the OECD. So that's really the work that's happening in this area. I won't be going through all of these 15 work streams. What we will focus on will be action points number 8, 9, and 10, which relate to transfer pricing. Now, The action point number 8 really relates to assuring that transfer pricing outcomes, or in other words, profitability, should be aligned with value creation. In simple words, what this really means is that the country which is actually developing or creating value should get the right to keep the profits that are generated as a result of that value. Okay. Now it's easier said than done. The principle is well understood, but how do you really go about it? And it was perceived that one of the key ways in which profit shifting is happening is when tax multinationals are attempting to move value across countries by transferring out intangible assets. Okay. Now there is a certain return which is attributable to ownership and control of intangible assets. And when you obviously shift intangible assets, the ownership of that intangible asset outside, it shifts value. So again, some of the action points that they're going to look at here are also overlapping with the work that OECD is already doing on the intangibles paper, and we'll talk about what those findings are. But one of the key things that they're looking at is to come up with a broad and a clearly delineated definition of intangibles. Now, this is one huge area of controversy in terms of how should intangibles be defined. So I'll just cite a few examples here. Excuse me. For example, should you look at only legally protected intangibles? For example, intangibles such as trademarks or patents which are registered? Or should you also look at intangibles which are more in the nature of value drivers or soft intangibles? Okay. For example, customer relationships represents the value of goodwill that a company enjoys. Now that's not a legally protected intangible, but it is a source of value. And in a value chain, if there is a transaction between two entities and one of the sides has significant customer relationships, it will reflect in their pricing as well. So how do you really define that? Another big issue in transfer pricing has been that for an intangible to exist, should it constitute a commercially transferable interest? Should it be something of that is capable of independent identification, and should it be capable of being commercially transferred out? That issue again has had divergent case laws in other parts of the world, and a case in point is let's say goodwill, for example. Now the accounting understanding of goodwill is that goodwill always attaches to the business, and you cannot transfer out goodwill unless you transfer business along with it. But is that principle necessarily right from a transfer pricing standpoint? You can have a situation where goodwill is not capable of being transferred out, but it will reflect in pricing. So the worth of that goodwill, two parties will take into account when they negotiate with each other under arm's length conditions. Sorry, yeah, go ahead.
Would you transfer price a geographical indication?
Geographical advantage.
No, geographical indication is an actual intangible. We have for example, I'll give an example, the Scotch whiskey, French champagne. India, you have Goan cashew fenny. Say, for example, if you're manufacturing fenny in Goa, you are protected and you can have a pricing premium.
Yeah. No, so that's a very.
But you can't transfer it.
So that's an extremely important question, which goes back to the whole issue of locational advantages, okay, or location savings. So when we talk of location savings, I spoke to location savings earlier, and there I spoke about it in the context of outsourcing. But you can have locational advantages when there is insourcing as well. When a foreign company wants to, let's say, distribute goods in the Indian market, which is what China is doing today. What China is trying to do is that it is saying that if you want to do business in China, you have to be ready to show higher profits, because if we do not allow you to do business in our country, you will not have access to the intangible that is there, which is the burgeoning consumer class in China. So when foreign companies are investing in China, they are actually benefiting from a locational advantage that China confers, and therefore that should reflect in a higher margin that multinational should leave in China. So that's an example of a locational advantage. What OECD says about this is that they say that as long as that intangible, for something to be reflected in transfer pricing analysis and taken into account, it needs to be an intangible which is separately identifiable. It needs to be unique to the taxpayer. Okay, hear me out. It needs to be unique to the taxpayer, and only if it is unique to the taxpayer and that taxpayer is able to confer or to derive a unique competitive advantage which is not available to others, only then it will be taken into account for transfer pricing analysis. So to take your example ahead, let's take the example of a foreign company who, I'm giving you an analogy. Foreign company invests in India. Let's assume there are significant entry barriers. So you need to go to the government, take an approval. Let's say it's an FDI restricted activity. So you have to go to the FIBB, take an approval, and that approval is not available to everybody, correct? So in that type of a situation, there is a locational advantage that is created, which is uniquely available only to you and not to others. In such a case, there may be a case for that company expecting a higher return because that advantage that it has is not available to everybody else. But however, take the case of a business activity which is open to everybody else. Okay. In such a case, the market would not be willing to compensate for that locational advantage. And therefore, in such situations, OECD clearly says that such locational advantages should not be transfer priced, but rather they should be factored in comparability considerations. Because when you look at the comparables, that comparables will reflect the advantage that everybody in that market has. So that's what
So you factor it down.
factor it in the comparables. You don't transfer price it.
It's already factored in. It's not automatic.
In some cases, it would be. So when we looked at the example of location savings, for example, if you are a contract manufacturer, and let's assume you're a pharma contract manufacturer for generic pharmaceuticals, there are thousands of contract manufacturers in India. Okay, so there's nothing unique there. There's nothing unique that the Indian company is offering to the foreign company, which it cannot get from somebody else, which the competitors of the foreign company would also not have access to. In such a case, the foreign company would not be willing, under arm's length conditions, to share anything extra with the Indian company. That is where, even if there is a cost saving which is achieved, which is a locational advantage, that cost saving will be factored in a comparability adjustment as part of the comparables, and it will not be transfer priced separately. Which is why I said earlier that the global view on location savings is that if there is no unique competitive advantage, then it has to be addressed through comparability, and once you give the right margin, then nothing further should be due. So definition of intangibles again is a very big area where again there are divergent views. I'm not getting into different theories around that, but I'll just list down which are the various issues on definition of intangibles. So okay, let's take the example of an R&D that you're doing which is so unique that it is extremely high-end, and which there are no players in India who are performing similar R&D, right? Now, if an Indian company has developed such skills that it is capable of performing such services which nobody in the Indian market is performing, then it is conferring a unique competitive advantage to the other side by performing that service. So the Indian company is then in a duopoly or a monopolistic situation, which is the intangible, and therefore under arm's length it can expect to get something more. So that would be an example.
Can you compare with some other country, like if some other country same advantage they are giving?
You can compare with other countries, but you will have to then make adjustments for geographical differences. So again, the principle is that if from the point of view of the foreign company who is outsourcing that service to India, it is not to say that other service providers in India are the only viable alternative. Insofar as the foreign company is concerned, they can get the same service from Philippines, they can get it from China, they can get it from anywhere else. So when you judge uniqueness of a competitive advantage, you have to take into account all of this.
Suppose we take an example wherein there is a parent company in US
See, again, if you can show that the foreign company has a realistic alternative available, okay, which confers bargaining power to the foreign company because it has an option. It can give that piece of work to India, it can give it to China, it can give it to somebody else, right? Assume for a moment that all three nations have similar capabilities. If that is what the situation is, it would put the foreign company in a stronger position, and under such a situation, it would not be prepared to share that cost advantage with the Indian company under arm's length, under independent third party situations. So what we are trying to do in related parties is to hypothesize that, think as if there were third parties. Would they be prepared to share that locational advantage? So here what happens in India is that the tax authorities always put the cart before the horse. They go to quantification of location savings without first answering this fundamental question, that what is that unique competitive advantage that India is really offering, which should entitle it to get that extra margin. Okay, so how you look at uniqueness is a question of how you understand where that taxpayer is in the industry as a whole, what is its position, is that service being uniquely offered, are there other service providers in India who can offer similar services, does the foreign company have a choice, those kind of questions you'll have to ask.
Supposing
No, no, I understand. No, but the question here is that not to say that there is no cost saving. Point is that the existence of a cost saving itself does not mean that something more should be paid. That cost, the question is that yes, there is a cost saving. Who does that cost saving belong to? Under arm's length, when would that cost saving or a part of it belong to India? It would belong to India when India is able to offer something unique. Now, a unique competitive advantage, which is not available through other service providers in the same market or similar markets, and which is not available to the other side, either from this taxpayer or from other taxpayers. So it has to be an analysis done on both sides of the arrangement. If that answer reveals that there is nothing unique in what India is doing, because that same service, there are many service providers in the Indian market itself who can offer the same service. It's like saying that, let's say you come to me for providing a service. I am one of the big four, right? I want to price my service at 5 lakh rupees, but if the rest of the big four are doing it at 2 lakhs, can I ask you 3 lakhs more? I can't, right? That's the point. So in a situation where the service that I'm offering to you is similar to what others are offering in the market, then the market would not be willing to pay a premium. When would the market be willing to pay a premium? When what I have is something which nobody else has. Now that's a fact specific case. So in a situation where you are doing, but you have to look at it vis-a-vis industry in India as well as vis-a-vis outside of India. So that's how the cost arbitrage aspect has to be looked at. I would believe that sometimes department confuses location savings with skills that the Indian company has. But I would say that having the necessary skills to deliver the service is a necessary and sufficient condition. If those skills are not there, I will not even give the service. So why should I pay something extra because you have the service? I'm giving you that work because you have that knowledge to deliver that work. So that's a condition precedent for delivering that work. That condition precedent cannot be a claim for an extra margin because you have that capability to perform that work. So that is how it has to be looked at. Can I, sorry, if you don't mind, I need to complete the rest of the slides. I will take questions again from everybody for the last 10 minutes, but allow me to complete if you're okay. How much time do we have? So on definitional issues of intangibles, what are intangible assets and how are they different from value drivers, for example, in a business? For something to qualify as an intangible, does it need to have commercially transferable interest? How do you deal with legally protected intangibles versus intangibles which are not legally protected, which can be in the form of customer relationships, for example, or which can even be in the form of know-how which is consciously not registered or patented to keep it secret, because once you register or patent it, it comes out in the public domain. What about goodwill? How do you deal with goodwill? Should goodwill be only taken into account for transfer pricing purposes whenever there is a business transfer, or should it also be taken into account otherwise while setting prices? Marketing intangibles, when are marketing intangibles created? There's a lot of confusion on that. When are marketing intangibles relevant? And if they are relevant, to what extent they should be factored in price setting? To what extent they should result in a higher or lower profit being paid to one of the entities in the value chain? What about workforce in place? When people are moving across continents, and that happens because, factories are shifting locations, for example. So a foreign company says, India is becoming too expensive. We want to shift the manufacturing plant from India to, say, Philippines. Is there a transfer of an intangibles? Because that plant, there would have been capable and highly intelligent people who would have been employed by that plant, and some of those people will move. How are group synergies required to be treated? Does it have a place in transfer pricing analysis? Those are kind of questions which are being really asked. Developing TP rules for, to ensure that transfer and use of intangibles are appropriately allocated in accordance with value creation. Now, the point here is that who in transfer pricing should be entitled to intangibles related returns. Okay. Now, here the issue is to first identify what is an intangibles related return. So let's take an example. Let's say there is an Indian company. That Indian company is a licensee for the Indian market. Okay. The foreign company is the legal owner of technology, for example. And the foreign company licenses that technology to the Indian company. And the question is that the Indian company has to pay some royalty. So how do you really determine the right royalty rate? Now, if it's a very routine intangible, you would probably find comparable license agreements and give it the same royalty rate as other comparable license agreements are showing. But there lies the misnomer that in real life, no intangible is routine. Every intangible is unique. Otherwise, it would not be an intangible. So then in that case, if let's say hypothetically the Indian company is earning a profit of say 25% on sales, right? Now some part of this 25% profit is attributable to the functions that the Indian company is undertaking. So let's say that Indian company is doing manufacturing and distribution and sales. So let's say if a contract manufacturer earns a 5% margin on cost, and let's say a distributor earns 4% on sales, let's say hypothetically the total return that India should get for its routine functions of manufacturing and distribution and sales is let's say 9%. So now you have removed 9% from 25% and you are now left with say 16%. Now who does this 16% really belong to? That's the residual that has remained in the value chain, which is in the form of super profit. The first step is to identify that how much of 16% belongs to India, because as a licensee it is exercising decisions on strategy. So some part of that 16% should belong to India, and some part of that 16% is contributed by the foreign company, because it is giving an intangible which is allowing the Indian company to earn that extra profit. So that's where you go into sophisticated profit split type of models, when you have hard to value unique intangible assets where value has been created on both sides. So here was an example where the intangible itself was extremely valuable that allowed the Indian company to make 25% profit, because making of the 25% profit is itself not common. Not everybody makes 25% profit, which means that surplus which is getting created, it is getting driven on account of something. That something could be use of an intangible, or that something could be use, management insights or strategy. So once you have first allocated routine returns for manufacturing and sales, and in my example it was 9%, the surplus of 16% has to be then split. Some of it will remain with India because India is exercising strategy, and some of it needs to go out to the IP owner. So that's the whole question on how do you really identify intangibles related returns. Okay. The second issue is that when you say that return for intangibles should be commensurate with value creation, you also are looking at, once you have identified what is that intangibles related return, who should that intangibles related return go to? Should it go to the legal owner of the intellectual property, or should it go to the economic owner of the intellectual property? And now the OECD has said in its intangibles draft that just because you are a legal owner, that by itself will not entitle you to get intangibles related returns unless you can show that you are performing functions that create those intangibles. You are performing functions that manage or take decisions on how to exploit those intangibles. You are performing functions to protect those intangibles. You are incurring costs to undertake those functions, and you are bearing risks as an outcome of those functions. If you can show all of these things, then you will be the legal as well as the economic owner of the intangibles, and only then you will be entitled to intangibles related returns. The party who has spent the money to develop that intangible. So this again is a big issue in transfer pricing, and even OECD Working Party 6 has not been able to find out the answer to this. That hypothetically, let's say in a cost contribution arrangement, and cost contribution arrangement is an arrangement where 2 or 3 parties come together and they say that we'll develop this intangible together. And one party puts in human resources in the form of scientists, other party puts in money, and the third party puts in, say, platform intangible rights, which are base rights on which you will develop something new. In this situation, what gets more weightage? Because if you really look at it, even the party which has put in money has undertaken significant amount of risk. So today the view of the OECD on this is that just financing by itself is not sufficient to give a party an intangibles related return. At best, you can give that entity a financing return, and if that financing return is not commensurate with the risk that is being taken by the financier, then you have to risk adjust that return. You maybe increase that return a little bit to take into account the risk, but the financier will still not get profits associated with exploitation of intangibles. Okay, so those are some of the principles which are getting tested. There are no clear answers on these things right now, but the push and pull factors between functions on one side, pre-existing intangibles on the other side, and financing on the third side, in terms of who gets to keep the profit, is a big issue in transfer pricing. Updating guidance on cost contribution arrangements. I just give you that example, which is the same point over here. So this is the parallel work that the OECD is doing, and somewhere the OECD has mentioned in the in BEPS document that there is a fair bit of overlap between the action point number 6 on intangibles and the work that is already being done on intangibles separately. And therefore OECD has said that the second discussion draft that was issued in July 2013 should be only viewed as work in progress, and at some stage they will converge the two work streams together to harmonize them. We talked about some of these things. There is a new section now in the intangibles draft discussing local market, location savings, assembled workforce, and group synergies. We touched upon it a little earlier on local market advantages and location savings. And there the principle is that if for something to qualify as an intangible, it needs to be unique, and it needs to confer a unique competitive advantage. It's only then the market will be prepared to pay you a premium. if that uniqueness is not there, and if that locational advantage is generally available to everybody, then it can only be addressed through through comparability considerations, and it should not be factored separately into pricing. Explanatory changes to the definition of intangibles. We talked about definitional issues earlier, so some of those things the OECD is going to discuss in the intangibles draft. What do you mean by intangibles related returns? There the OECD is essentially looking at between significant people functions, between financing, who gets to keep the money, net. New transfer pricing section on transfer pricing aspects of use of company names. Let's say, for example, you have subsidiaries in the US market, and by default those subsidiaries carry the names of the parent company. Should that require a separate charge? That's again a question which is being looked at. Reorganization of guidance on methods and comparability analysis. Now again, for intangibles, most of the methods that you have in transfer pricing will not always apply. So profit-based methods will generally not apply. You would usually look at cups, but again the comparability criteria for cups is very, very stringent, and therefore because inherently intangibles are unique, you will never have a cup. So, or there are few situations where you will have a cup unless a certain royalty agreement is also there by the same party with a third party. So if your parent company, let's say, has a license agreement with India, but in China they don't have their own subsidiary, so they operate through a third party, and in China they may have given a similar license in favor of a third party, that can be a cup. But generally outside, you will have few situations where you have genuine cups for intangibles. In what circumstances the profit split method should be used for dealing with intangibles? Profit split method is typically used when both sides of the transactions have non-routine intangibles. Okay. When you just have one side having non-routine intangibles, you would typically test the other side which doesn't have an intangible under TNMM. So the least complex entity is typically tested under TNMM. But what happens in a scenario where both sides to the transaction have unique intangibles? In such cases, you are left with no choice but to apply the profit split method. Work on hard to value intangibles reserved for further work as part of the BEPS project. So that's the work that is happening on the intangibles draft. OECD BEPS Action Point 9 extends the concepts of Action Point 6 to risks and capital. And there, the point over here is that the OECD is looking at preventing BEPS by transferring risk amongst or allocating excessive capital to group members. So the principle that OECD has always emphasized, even before BEPS became so important, is that you cannot transfer risks through a contract. You cannot, between independent third parties, say that this company will take all the risk and that company will be stripped of the risk, and therefore if that other company is stripped of all the risk, that company should get a routine low return, and whatever remains should go to the company that bears the risk. Today we've reached a stage where you just cannot transfer risks in a contract. Risks will attach to that company which has the functions which create the risk and the functions which manage the risk. Now, what do you mean by functions that create the risk? So the key word that the OECD has used is control over risk. What does it really mean by control over risk? What it means is that the entity which is taking decisions that put the capital of the organization at risk, that's the decision that is exercising control over risk. So let's take the example of a product launch decision. Foreign company takes the decision to launch a certain product in the Indian market. Foreign company is the parent company. The Indian subsidiary implements that decision, right? Now in this situation, the decision to launch a certain product has already been taken by somebody else outside of India. If that decision succeeds, then the profit attributed to that decision should go to that party who took it. If that decision fails, because that's the decision that puts the capital at risk. If the decision fails and the Indian company makes a loss, then logic would have it that part of that loss should go to the foreign company because the decision was actually taken there. So that is what OECD is trying to say when it says that how the risk is allocated between related parties has to be linked to who undertakes the critical functions that create the risk or that manage the risk. And for managing the risk, it is not necessary that you have to undertake those functions yourself. you can always choose to outsource some of those functions to third parties, provided you ensure that you ultimately control that function. So in a situation where the foreign company, let's say, does monthly review meetings, and they look at how the Indian business has performed, they give targets to people, and they pull up people for not meeting targets. When you have this kind of situation, that's the mechanism that the foreign company is actually putting in place to manage that risk. So those, and that's the reason why today you see that the so-called hybrid organization structure is actually creating a whole lot of issues in transfer pricing, because in a hybrid structure it is very difficult to figure out who really took the decision and who should be entitled to entrepreneurial returns. And mind you, entrepreneurial returns could be a combination of people-related returns as well as intangibles-related returns. So that's really the controversy here.
Indian capital service provider who is 100% providing service to its parent company, there is no control over the functions by the parent company, but the contract is secured by the parent company. So in this situation, whether OECD is also use that Indian company to get an entrepreneurial return?
No. So in this example of yours, it is the foreign company that is the market facing entity. So it is the foreign company that goes into the market, fetches customers. It is a foreign company who's primarily liable to the customers. So if there is a service defect or a product liability that arises, it is the foreign company that will bear that risk. The foreign company also has market risk. Okay. The Indian company here has to execute instructions of the foreign company. So there are no entrepreneurial functions there. They are told what to do. There may be a statement of work or an SOP. An Indian company just has to execute. In this type of a situation, the function which creates the risk is sitting outside India. And therefore entrepreneurial returns will go to that company after the Indian company has been rewarded with a routine steady return for its functions. OECD BEPS Action Point 13 is on transfer pricing documentation. Now, here, what the OECD has recognized is that there needs to be consistency in the manner in which transfer pricing documentation is prepared by different governments. I'll come back to this slide again. But what is really the purpose of transfer pricing documentation? One is that it should be an enabler for the tax authorities to assess what are the transactions that require further scrutiny. So some sort of a risk-based audit. It should be an enabler for the taxpayer to demonstrate to the satisfaction of the tax authorities that his transfer pricing is all right. So your transfer pricing documentation should convey that. And your TP documentation should be start of a income tax audit. Those are the threefold objectives of TP documentation. Now, what's happening around the world is that documentation requirements and documentation best practices around the world widely differ. So our documentation may require us to report certain things. Documentation in the other side may not require us to report certain things. Sometimes our tax authorities may expect Indian company to maintain information which may not even be relevant for transfer pricing analysis. So for example, when you have selected India as the tested party, and for example, when you showed that there are no cups at all, how is it relevant? What are the prices at which US is selling to Russia, for example? But they will want it. So, and some of it is dictated by local transfer pricing rules as well, in terms of what a taxpayer is expected to maintain and provide and what they are not expected to maintain and provide. But there is a need for harmonization. One, because what's happening is that cogent information is not being reported so that tax authorities can start proper audit. And sometimes it creates a whole lot of information gaps, and that in turn creates transfer pricing challenges. So the objective of Action 13 is to come up with guidelines on what should be those documentation best practices, and this is still work in progress. Broadly, what the OECD has presented as a proposed solution is a two-tier structure for TP documentation. Now, what happens really is, let's take an example. Here, we prepare our own transfer pricing documentation. So you may either get a TP study done internally or you will outsource that to some consultant, right? Now that TP study presents the picture of what are India's transactions and what does India do and whether India gets rewarded properly for those transactions or not. But from the point of view of the tax authorities, does it tell the tax authority that how is India positioned in the overall value chain? To what extent is India important or unimportant if you look at the entire supply chain? Okay, that bird's eye view is never presented. So as a reaction to that, what OECD is now proposing is that documentation needs to be prepared at two levels. At the central level, let's say in the headquarter company, you will have a master file. That master file will document information about your group. It will document which are the various countries where you have operations, what those countries are doing. Are they performing manufacturing? Are they doing distribution and sales? Are they doing R&D? Are they owning intellectual property? What are they doing? Okay. What are the key contracts that you have? Where is your place of effective management? Where is your decision making happening? Which entity is owning intangible assets? So that is the bird's eye view. Okay. And that bird's eye view, the OECD is now recommending that that big picture should be documented in a central master file. Okay. Once you have that big picture, then on a country by country basis, you can then supplement that big picture by documentation which is necessary for that local country. So the functional analysis of that Indian subsidiary can be there in the local file. It need not be there in the master file. Okay. Based on the functional analysis of the Indian company, what should be the margin that it should earn? Part of local file, not part of master file. So that's the two-pronged approach that they are recommending. The other thing which OECD has recommended is this first bullet, which is creating significant controversy everywhere in the world, which is this whole thing of country by country reporting. Now what the OECD is saying over here is that as part of the master file, they want taxpayers to report topical information about their global operations. So what is required to be reported? Okay. What is required to be reported? And right now they have just said that this recommendation that the OECD has made does not represent the consensus view of the OECD nations. So they have invited comments from different stakeholders. So a lot of water will flow before this is actually formalized. In fact, there are many nations which have actually resisted this significantly. United States, for example, is saying that the moment you start reporting your global information in the form of, which country is making which margin, what is the sales of each country, it is going to lead to formulary apportionment. Tax authorities will say your global sales are broken down into 15 countries. Let's break down your global profits into 15 countries in the same ratio. That's formulary apportionment. United States has asked the OECD to give a commitment that this data, if reported, first there has to be a commitment that this data will not be used to formularily apportion profits without applying the arm's length standard, because it will be completely ridiculous to do so. So what is this data that is, that is being expected now? They want companies to present this information for all their associated enterprises. I think I'll take another 10 minutes. Present this information for all associated enterprises in a consolidated place. So OECD has actually come up with a template for this. This template will evolve. This is currently a draft template. But what this template effectively requires is the following. That template requires every associated enterprise in the world, including permanent establishments that are treated as separate taxpayers, to report the following. You are required to report where does your place of effective management lie. Okay. And there OECD is going back to the definition of effective management as per Article 4 of the treaty. Okay. They want you to report what they've assigned some activity codes. So they have assigned activity codes for manufacturing, procurement, distribution and sales, R&D, IP ownership, insurance, financial transactions. And you have to, in that template, against each entity, mention the activity code, which will signify what that entity actually does in the entire value chain. Okay. they want each entity to report the sales of that entity. So sales to related parties and sales to third parties, including other income. Okay, they want entities to report earnings before interest and tax. They want entities to report the tax actually paid on cash basis, and they are saying that it should be reported into three baskets: tax paid to your own government, tax paid to other government, and withholding tax deducted against income payments made to you. All that has to be reported. They want companies to report their total employee cost in each country and total number of employees that they employ in each country, including secondments. It doesn't matter where that employee is actually performing his work. He may be on Singapore payroll but performing work in India, but Singapore will have to report him. So that's the level of information that they are actually asking in this template. Now, there are a whole host of issues around this, and there are really no guidance is given by the OECD. The OECD has recommended that you have to follow statutory financial statements while giving this information, which also means that when you report this information in a massive template, the numbers will not be comparable, because India will report profits for March 31 year end, US will report for December 31 year end, India will report in rupees, US will report in dollars, accounting conventions will also differ, so there may not be full comparability of this information. And clearly at this point OECD is not really dictating this way or that way. They've left it for stakeholders to comment on how they would want to report this. So this is another big thing that is happening. We do not know at what stage this will hit India, but somewhere this is going to come to India at some stage, where our own tax authorities will use this template, devise their own template and notify something. And the key here is that while OECD has clearly said that the objective of this kind of reporting is not to substitute a proper transfer pricing audit. This is just meant to be a starting point so that tax authorities can know where to focus on. But that does not mean that this should be a replacement for a TP audit. So just because some other country is showing higher profits and India is showing lesser profits, that does not automatically mean something is wrong. Okay, while OECD has cautioned this, on the ground very much how it will progress. So this is being viewed as something which is a significant development, which will cause a lot of controversy as we go forward. General anti-avoidance rules and transfer pricing. So here I'm not going to focus on the theory around GAR. I think much has been spoken and discussed about GAR, but what we will talk about here is to what extent GAR and transfer pricing really interplays. Okay. So what does GAR really say? Just a few minutes there. That GAR seeks to attack impermissible avoidance arrangements. What are such arrangements? They are arrangements which are entered into with the primary motive of tax avoidance or obtaining a tax benefit, where one of the objects or part of the object is to secure a tax benefit, and any of the four conditions are satisfied. Okay, creates rights and obligations which would not normally be entered into if the transaction was implemented at arm's length, results in directly or indirectly in the misuse or abuse of provisions of the code, lacks commercial substance, or is not for bona fide purposes. Now let's just stop here before we go any further. If you look at our what the OECD has been saying internationally in terms of in what circumstances tax authorities should be allowed to disregard transactions completely. Okay, OECD says that it should be in very rare circumstances that the transaction as actually undertaken by an entity should be completely disregarded. If there is non-arm's length behavior, OECD believes that as far as possible such non-arm's length behavior should be addressed through pricing adjustments and not by redrawing the lines between the boxes. Okay, and OECD is of the view that in many situations, taxpayers undertake transactions which are generally never undertaken or will never be undertaken between third parties. Okay. Now that does not by itself mean that something is necessarily wrong. So let's take the example of a low risk distributor. Now, low risk distributor as a concept is there in transfer pricing, but you will rarely find it in third parties. You will never find a distributor being a low risk distributor in third parties. Does that necessarily mean that low risk distributor, which is like a transfer pricing fiction, is necessarily a bad thing? No, not really. Their OECD says that as long as that activity, okay, is aligned, the reward that you give to that entity or the risk that you allocate to that entity is aligned with the function which is being carried out. And as long as that entity can be transfer priced appropriately, you should still respect that structure and not challenge it. So in the context of an LRD, what it means is the LRD's functions will have to be simple. Because if LRD is undertaking, let's say, strategic functions, strategic decisions, then it cannot be a low risk entity. Then the risk associated with those decisions will also be contractually allocated to that entity. So there, conduct is aligning with legal form. Okay, as long as conduct aligns with legal form, as long as you can determine through transfer pricing analysis the right reward for an LRD, it should not be challenged, even if an LRD structure would generally not exist between third parties. This is what OECD says. Now, to some extent, this principle was enshrined in our own jurisprudence. So we had Azadi Bachao Andolan, we had many rulings before that, Duke of Westminster, McDowell's, the whole controversy, and finally dust settled when the Supreme Court finally said that the tax authorities should ideally respect a structure as given, as long as that structure is legal and it is not a sham. Now, sham essentially means economic substance. So, so sham means non-est. Something that lies on paper does not lie in real life. Now, when would that happen in a transfer pricing context? When you call somebody a low risk distributor, but it doesn't have the functions of a low risk distributor. When you call somebody a contract research service provider, but that contract research service provider also takes strategic decisions about control of R&D, what products to develop and stuff like that. So that's a situation where conduct is not aligned with legal form, and that's a sham type of a transaction. So our existing jurisprudence said that in a situation where the transaction is legal, or in a situation where it is not a sham, tax authorities should not ask the taxpayer why he did a certain transaction. Okay, but GAR in many ways tries to change that. Now, if you really look at the first bullet, creates rights or obligations which would not normally be created if the transaction was implemented at arm's length. It's trying to indirectly ask you, is this transaction commercially rational? Would this transaction typically be undertaken between third parties? So that is indirectly getting into the domain of why did you undertake this transaction. So there is a change, a paradigm shift in how our law will evolve, where till date the principle was that the tax authorities cannot sit into the shoes of the taxpayer as long as certain conditions are fulfilled. But now they can actually ask you, why did you do this transaction? Please explain why this transaction is something that would not be normally created if the transaction was implemented at arm's length. Look at the last bullet, is not for bona fide purpose. Under Indian law, where was the need to show bona fide purpose earlier? As a businessman, I may take a decision which may or may not work. I may become a loss maker. But why should a tax authority sit in judgment and say that you did not take this decision right? This was never the requirement, but now GAR is trying to bring in that requirement. Under our current transfer pricing code, if you look at how it is worded, 92(1) says, income arising from an international transaction shall be computed having regard to the arm's length price. Okay. So first, your charging section has to be attracted, section 4 and 5. And under section 4 and 5, read with 224, there first ought to be income. If there is income that arises on account of a transaction, then the mandate of the TP code is to compute the arm's length price, because it says income should be computed having regard to the arm's length price, right? In 92(1), which is our arm's length standard, there is a mandate to reprice a transaction. There is currently no mandate to recharacterize a transaction. Okay, but if you look at what GAR is trying to say, it is giving you that power to recharacterize the transaction. In that sense, our treaties are a little more widely worded than section 92(1), the way it is written right now. If you see article 9(1) of the treaty, which deals with associated enterprises, 9(1) says that when conditions are made or imposed in dealings between two parties which would not otherwise have been entered into between independent third parties, then tax authorities can seek to adjust. The wordings used are conditions are made or imposed, not similar to how they would be undertaken between third parties, which is again similar to the first bullet. So the mandate under Article 9 is much wider than the mandate under 92(1). And now, once GAR comes into effect, you will have the tax authorities, getting this additional power to ask you the why question, that why did you do this? So let's now look at how does it really apply. Now, our finance minister had, in a speech, mentioned there was this huge issue about is GAR really necessary when you have SAR? Now transfer pricing is an example of a SAR, where it is a specific legislation to counter avoidance measures, right? And the whole issue was that if you have TP code there in the statute already, do you really need GAR? And to what extent GAR will override TP? So what happens in a situation where your transfer pricing officer otherwise doesn't have a problem with how you computed the arm's length price, but still challenges you because your transaction is for saving taxes, for example. So there, unfortunately, people were expecting some answers in the recent notification that was issued, but that answer still has not been answered. That question has still not been answered. So how will it really interplay? The way I see it is in two levels. If you look at thin capitalization, one of the things that the tax authorities have given themselves the power under GAR, provided those four conditions are found to exist, is that they can recharacterize debt into equity or equity into debt. Okay, so for example, in a scenario where they believe that you have taken excessive debt on your books, and that excessive debt on your books, so your leverage is very high, and therefore that gives you a higher tax deduction, and therefore that's the way through which you are bringing your global effective tax rate down. And if they challenge your debt equity mix, then they can recharacterize your debt into equity. Now that throws lots of issues. One is that on a standalone basis your interest may have been otherwise arm's length. So here the issue is not about what the right rate of interest is. Here the issue is that on what base should it be applied? Is your debt equity mix the right mix? What happens in a situation where they come in and recharacterize? Does it mean, so obviously, the interest that you claimed as a deduction, they will disallow that. But will they charge DDT on that as if it is declaration of dividends? I mean, where do you really take this logic to its conclusion? That if debt is treated as equity, does that mean interest payout is the same as dividend? Currently, as the way TP rules are worded, as I mentioned earlier in the share issues controversy, we still do not have provisions that allow secondary adjustment. So this is an issue that I foresee coming up. Insofar as business restructuring is concerned, transfer pricing, the way it is currently worded, section 92 to 92E, will deal with commercial substance. So what that means is that if your conduct is not aligned with your legal form, if you are allocating risks to parties which do not have the functions which create those risks, if those kind of situations happen, then under the TP code, they have the power to reprice. So under the TP code, commercial substance becomes very important. But under GAR, in addition to commercial substance, commercial rationale becomes also important, because as I mentioned, now they have the power to ask you the why question. Okay. What about that you do a business conversion where you convert yourself from a high risk entity to a low risk entity? The issue of whether an exit charge should be paid is a transfer pricing issue. And in my last session last week, we dealt with this issue. So whether an exit charge is payable on a business conversion or not, the TP provisions will deal with that issue. But having converted into a low risk entity, whether your conversion itself was fair and whether that low risk model will be acceptable to the tax authorities post conversion is a GAR issue. So that is how I see transfer pricing interplay with GAR. So insofar as this is concerned, three quick takeaways. Economic substance requirement was always there. Now, in addition to that, commercial rationale also needs to be documented, and you have to actually have robust documentation that satisfies these tests going forward. Way forward, you know, if you see what is happening, there are so many things happening in the world. The whole initiative on BEPS, the whole initiative on country by country reporting, the 15 work streams of BEPS. The world is going to be a very, very difficult place to live in because of all of this. Because how do you really implement an initiative which is as huge as BEPS? Insofar as transfer pricing is concerned, I would believe the solution perhaps is a little easier, where OECD will rewrite their commentary on transfer pricing on those 3 action points on BEPS, and therefore new guidance will come out. But on the other action points that were there, digital economy, hybrid mismatch arrangements, CFC rules, I think many of these action points, the solutions are not so easy, because for governments around the world to implement these solutions, some government has to give up taxing rights, some government has to assume taxing rights. Bear in mind that we have more than 3,000 treaties around the world, and it is not going to be easy to amend 3,000 treaties to give effect to BEPS recommendations. So the only way this can happen is when you have a multilateral instrument, which is like an instrument which will override all treaties on certain aspects, on interpretation issues, for example, which will be somewhat akin to a Vienna Convention, for example. And then if you have a conflict between 2 treaties, if there is double non-taxation, then you'll have to look at the multilateral instrument for guidance. That's the only way it can happen. How soon the world will get there, anybody's guess. They have given action points here, September 2014. Those are only action points to come up with a paper. The real work will start after that. So I do not foresee that in the next 5 years at least, you will see BEPS recommendations being fully implemented. But what will happen is, while OECD has clearly said that governments should resist the temptation to, you can look at unilateral measures, because it will lead to chaos. If you try to solve all this through unilateral measures, it's going to be chaos. But that's what will happen. So you will have governments reacting independently to address BEPS challenges. And in some ways, it's already happening. So GAR is a reaction to avoidance here. If you look at, they made in a couple of years ago a requirement that if you are having transactions with specified countries where India does not have effective exchange of information, then TP provisions will apply, even if that transaction is a third party. If the foreign company does not have a PAN, 20% withholding tax, 25% withholding tax will apply. What are all these measures? These are unilateral measures that our government is taking to protect its own tax base. And those measures will just increase. So how does a corporate really deal with all of this? The way to really deal with this is, a corporate has to really ask itself this question, that is my approach to tax planning globally appropriate and fair? Am I willing to stand up in a public forum and discuss my tax policy transparently? And if the answer comes out that perhaps you are concerned about talking about your tax policy in a public forum, it means there is something wrong. Today, organizations cannot afford to plan on the ground or assumption of non-detection. Those days are gone. Nothing is going to be hidden after country by country reporting gets implemented. So you cannot plan on the basis of non-detection anymore. And therefore, and look at the reputational risk that is coming up. Today we are living in an era where there is breaking news being shot out on television every 5 seconds. So we are not in an era where these things will stay hidden. And reputation risk, look at what happened to Starbucks. I give you the example of Starbucks, where they voluntarily agreed to pay 20 million in taxes in the UK, not because they had done anything wrong. They had not done anything wrong, but they wanted to prevent an impact on public perception. They saw that their sales would dip because of this. So that's the era that we are living in. In that kind of an era, the business and the tax function has to work together. We heard the previous speaker, Mr. Kothari, talk about the same thing, where marketing and sales and production and the headquarters have to work together. tax planning ideas have to be aligned with actual business plans. You have to align internal and external documents. External documents could be in the form of CFO statements that are made on a quarterly basis, what you write in your annual reports, what your parent company writes. India writes that I am a low risk service provider, I do not add any value in contract R&D. Foreign company writes we are developing path breaking products in India. So those kind of things you will have to be very careful about what kind of message is going out through your public statements that are being issued in different parts of the world. And wherever possible, use techniques like advanced rulings, APAs, safe harbors to mitigate risk. So that's, I think, is the order of the day. Thank you.
Coming to the pleasant task, Natubai, dear fellow participants, you all will agree with me that Bipin Pawar during his second innings have touched upon in brief various important developments that took place in OECD and UN between September and March 2014. He also explained in details various nuances covering base erosion and profit sharing, general avoidance rules vis-a-vis transfer pricing documentation, and also taking up some questions raised by the participants. This will go a long way in interpreting the nuances in BEPS and GAR. So we are very thankful to you for sparing your valuable time and enlightening the participants on the subject. I, on my personal behalf and on behalf of CITC and on behalf of all the participants present here, propose a very well-deserved vote of thanks and request you to carry it with loud applause.
You can catch him during lunch hours.
Now we break for lunch and we reassemble at 2 p.m.